Believe it or not, there are millions of retirees who live off their investments and pay zero income tax. Not a loophole, not a trick. It's sitting right there in the system. The surprising part? They didn't start planning at 65. They started years earlier. Myth 1. Tax-deferred equals tax-free. Most people do the right thing. Put everything into a 401k. Get the tax break now. Feel good about saving. It feels smart. But here's the catch. You skip the tax bill before, so you pay it later. Every dollar you pull out in retirement gets taxed as income. Even the lowest rate is still a slice gone. Take too much at once? You can jump into a higher bracket without even knowing. This is why so many retirees are shocked. They saved for decades and feel like they're still paying bills. Myth 2. Pay tax later equals better. Here's the twist that most people never hear. Paying some tax now can save a lot more later. That's where the Roth account changes everything. With a Roth, you pay tax today. Every dollar you withdraw later is tax-free. Contributions, growth, withdrawals, all tax-free for life. No surprises, no jumping brackets, no panic, just freedom. The switch most people miss. You can even move money from old accounts into a Roth. It's called a conversion. You pay tax on what you move. But after that, it grows tax-free forever. People often use low-income years to convert a little at a time. Small tax now, big freedom later. Why it matters before retirement? Because once you retire, the window is smaller. If you wait, Social Security starts, required withdrawals start. Tax brackets shift. Every dollar becomes trickier to manage. The people who seem lucky aren't lucky. They were just early. The other tool most people miss, a taxable investment account. Sounds boring, but here's why wealthy retirees love them. Gains after 1 year are taxed differently, often lower, sometimes even 0%. If your income is low that year, you could sell investments and pay no federal tax on the gains. No tricks, just rules. Real estate, the silent helper. Rental income sounds like it gets taxed, and technically yes, but homeowners use repairs, mortgage interest, property tax, depreciation. Those deductions can reduce taxable income. On paper, it may look like the property loses money, even while it's bringing in rent. Cash in your pocket, little taxable income. That's why many retirees use rentals. The point is not zero. The goal isn't to avoid tax forever. The goal is control. Control over where the money comes from, when you withdraw. How much gets taxed? The secret is balance. Some money grows tax-free. Some is taxed at lower rates. Some is deducted. Like different doors to the same house. Use the right door at the right time, and you keep more of what you earned. This is why pros matter. Tax planning is complicated. Don't do it alone. A good professional can time withdrawals, manage conversions, keep you in lower brackets, prevent surprises. Paying a planner a little now can save you thousands later. That's the point. The takeaway. Here's what the retirees who pay zero federal income tax do differently. They don't rely on one account. They build 3 buckets: tax now, Roth; tax later, 401k, IRA; lower tax, brokerage, real estate. Then they pull money from the right bucket at the right moment. That's it. Not luck, not a loophole, just planning. The real question is, you don't need to know every rule. You just need one shift. Start preparing before you retire. Because the earlier you begin, the easier everything gets. So ask yourself, which bucket needs attention next? Not tomorrow, not one day, just next.